The latest producer price index, that's the inflation at the wholesale level, rose 0.5% in March, coming in lower than economists expected. That's the good news. The bigger picture shows on a yearly basis, producer prices are up 4%. Driven largely by surging energy costs amid the war in the Middle East. Let's bring in financial expert Jeffrey Small, partner at Retirement Income Source. Jeffrey, good to have you back. So,
thank you.
Are we seeing real progress here on inflation, or are inflation pressures shifting?
I think they're shifting, and I think the PPI number is a reflection of what's yet to come. I don't think energy had time. The recent energy spikes have had time to increase the PPI, which is really what producers are paying for materials that they buy before consumers get a chance to buy them. And so I think it remains to be seen. I think we'll see a better number next month and the month after that. But it looks like energy is starting to moderate now with the bombing stopping, which takes pressure off of inflation due to energy.
So should families expect lower prices for the rest of the year?
I don't think that's realistic right now. I think energy is going to stay elevated as long as we have the tensions in the Middle East. We should see energy above 85 a barrel. It's in the low 90s today. The market's rallying because of the drop in energy. A few tankers have come through the straits today, and Iran has changed their tone a little bit. But no, families should not expect immediate relief, not probably until the fourth quarter of this year.
Okay, what about rate cuts? Many Americans are desperate for them. Are rate cuts still realistic this year, or maybe are they going to be pushed out further, higher for longer?
We see them getting pushed up higher for longer. At the bare minimum, we may see a quarter-point rate cut in the fourth quarter. And it's going to have to be data dependent again. The Fed's not going to react unless, of course, inflation is calming down. We do expect the Iran thing to be resolved in the next 60 to 90 days. And that'll take pressure off of inflation, take pressure off of energy prices. And that'll give the Fed hopefully a chance to collect some data that shows a trend of inflation at its target of 2%. And so we were at 2.1% before all of this for 3 months. But we really need to see a longer term trend of 2%. And that has to be confirmed, of course, for the Fed to really take action. But yes, many things are languishing in the credit markets because mortgages are very high, car financings are very high, credit cards are very high, and that's really putting quite a hurt on consumers.
Okay, so bottom line, if rate cuts are delayed, what is the one financial mistake Americans should avoid right now?
The one financial mistake right now, it really has nothing to do with rates. It has to be with the market being very, very high. We've had an average of an 18% correction in a midterm election year. We're back to above break even now for the year-to-date performance of the S&P 500. And I would tell the investors out there that they should probably take the time to take some money off the table at this stage of the cycle. There should be some more volatility coming down the pike.
Right. Jeffrey Small, partner at Retirement Income Source. Appreciate your insight today, as always.
Thank you.
You got it.